Yo, what's really good, people? Welcome back to the channel. In today's episode, we're going to talk about the top movers and fallers. I bought one stock, which was a little bit of a punt. Not even a little bit, it was a full-on punt. So I'm going to talk about why I've done that. But my theory on, having a bit of just for fun investments within your portfolio as well. And I'm going to talk about markets bombing. Obviously, this week you can see I'm on the 7-day graph, and it's not been a pretty picture for this week. It's just been falling, and there's been a number of reasons why. So I'm going to shed some light on that. But if you want to know more, please like, comment, subscribe. Help the channel get to 7k subscribers. Follow on Instagram and Twitter at Infant Investors. And if you are new to the channel, I'm using a free trade application. My link will be in the pinned comment and description. freetrade.io/infant-investors. Click on the link, sign up, deposit £1, and you will get a free share of up to £200. So it's definitely worthwhile doing that if you are new to investing. But first, let's get into the top movers within my portfolio. The first top mover to speak about, which is a stock that we haven't spoken that much about in probably, I'd say, quite a few months, is pineapple. So pineapple, as you can see from this week, has gone up 1.6%. It kind of dropped towards the very last day of the week, but by Wednesday it was actually up about 5.81%, as you can see here. But due to some other factors which we'll talk about, it tailed off during the end of this week, but overall it still managed to be within the top movers for this week. And the main reason for Apple being being one of the top movers is price target. So we talked about this in a lot of previous videos when analysts that are following a particular business, a particular stock or sector or industry change their price outlook or change their buy rating for a specific stock. That can have both a positive and negative impact on the price movement of that stock. So there's been three major banks, HSBC, Wells Fargo, and Bank of America, that have been monitoring Apple stock. And for different reasons, which is quite positive, they've all felt that Apple's rating should either go from a sell to a hold or from a hold to a buy, and that their price targets all different between the different banks, but they've all increased for various reasons. So in the case of HSBC, they have a strong suspicion that, due to the COVID situation, Apple's services business and services numbers will come across strong. So things like Apple TV Plus, things like Apple Arcade, and all of the other services parts, which is nothing to do with their hardware, will come through strong. They also believe as well that, there's going to be a number of healthcare applications that Apple might be behind or supporting, which might become a bit more prevalent in the months to come as well. So, I think that's a theory, but they're just thinking that, healthcare is one of the biggest sectors in the US, and Apple can play a major part in doing that. So that's HSBC's reason. In the case of Wells Fargo, they actually believe that Apple will increase in terms of their iPhone sales and the iPhone numbers, and they also believe that whatever they release at the end of this year is going to have a bigger impact as well. So they're quite strong on that. And in the case of Bank of America, they actually believe it's due to more 5G and the increased demand for wearable technology. So they've increased their buy rating for Apple. So all of those factors have had a positive impact to Apple's share price this week. As I say, it did tail off towards the latter part of the week. But obviously it's good to see that Apple has gone up. The second stop in the top movers is Shopify, which is right there. And you can see it's 1.63%. And Shopify, to be honest, has been going through what's called a consolidation period. So, if you look at it over the month graph, you can see that it's basically been quite a sustained period of sideways movement. Since their peak of like 825, it's kind of gone up and down, and it's kind of moved sideways. Although you can kind of see it's a little bit lower than, say, where it was here. Overall, when you're looking at it broadly, it looks like it's a bit more of a sideways view. And there's a number of reasons for that kind of sideways period. I think one of the main reasons is that due to all of the whole, relaxation due to COVID, and, different states and different areas are easing and people are gonna, be shopping again and, back out again, etc., etc. That's, I think, obviously caused the initial drop. But obviously there is still a lot of uncertainty around COVID. So I think people are in this state where they don't know whether Shopify is going to be, going to surge up or surge downwards, because they don't really know what's going to happen in the short term. So that's why there's been this bit of consolidation period. Typically from a trading perspective, when you see, a lot of sideways movement, the stock price is going to do one of two things. It's either going to surge upwards or it's going to surge downwards. So I think the next couple of weeks for Shopify will be interesting. It all depends on what's going to happen. We're seeing places like New Zealand are saying they've got 0 cases now, 0 new cases, and everyone's free, and they're going to be relaxing completely. But then you're seeing in places of America, certain states are saying, sometimes some of them are getting their highest numbers. I think the state of Texas announced their highest COVID numbers, and it's growing. I think Brazil also announced that as well, and a few other places. So it's really, really sketchy. It's kind of patchy across the whole world right now. So with businesses like Shopify, which obviously rely on people doing online shopping and, have benefited from people being at home much more rather than going out to retail outlets, I guess it's a little bit uncertain what's going to happen. But, this week it went up 1.63%. My personal opinion is that it probably will slide down a little bit more. I'm thinking, but I think the long-term fundamentals will have to kick in, and I still see this as a long-term play. So, I bought COVID. Hopefully, I didn't buy no COVID. I bought Shopify way before the whole COVID situation, before there was even an understanding of what COVID really was. And genuinely thought about the business as a long-term hold. So obviously it's benefited from COVID, which is great for me personally, but I'm definitely not in the mood to sell it right now. I'm probably going to hold it for the time being, or maybe until the recession kicks in, who knows, because shopping will probably decrease then. So yeah, that's the situation with Shopify. The last stock to talk about, and you can see all 3 of these stocks are in order, which is very, very interesting, is Sentiment. Sentiment, from being the top faller of last week, and you can kind of see from the month graph how much it fell, to being the top mover for this week at 8.99%. And it's primarily due to gold. Gold and silver prices are much higher this week, based on the Fed presenting a gloomy outlook for the US economy. So, I mentioned this on a countless number of occasions, because Sentiment is a gold miner. Not only does it have its own business fundamentals, but it also benefits from, the movement of gold. And benefits is a loose word. It depends, obviously, if gold is going up. But if gold goes up, then sentiment tends to go up with it as well. So that's pretty much been the reason for that. And I think you'll probably see the same when you look at, Barrett or Greatland, or some of the other gold mining stocks, or maybe even silver mining stocks as well. Investors flock into safe havens and commodities during the times of gloomy outlooks. Then yeah, it's kind of normal and kind of expected. So that's the behavior there. Now that is the top movers. On to the top fallers for the week, and the first top faller to talk about is Uber. And that sound is just that 13.05% down this week. It's been painful. So Uber's fallen 13.05% down this week. Uber was actually doing quite well. It was actually starting to rise quite nicely for a number of reasons. Hit highs of 37.21, then down to 32.4. So the reason why Uber just skirted all the way down is basically they failed to acquire Grubhub. So this is mainly a US issue, but obviously if you're investing, it's worth you noting. So in the US, there's basically 4 main food delivery businesses. Uber Eats is one of them, Postmates is another one, DoorDash is another one, and Grubhub is another one. And in the UK, 3 of those 4 aren't prevalent in the UK. In the UK, you've got Uber Eats, and then you've got Just Eat, and Deliveroo, obviously. But in the US, those are the 4 main food delivery services: Uber Eats, Postmates, DoorDash, and Grubhub. And they basically make up the food delivery market. So Uber basically tried to do a merger and acquisition with Grubhub. And that's what they've been eyeing up over the past, couple of months. And that's partly why the stock price has been rising, because, there was a strong indication that Uber would acquire Grubhub. And if they did do that, then they would have owned 48% of the market share of all food delivery within the US, which, is obviously a significant stake and market share effectively. So that was their goal. That was their plan. However, their plan was railroaded by unscrupulous antitrust officials who just felt that from the perspective of a competition standpoint, Uber would own too much market share. Now, there is still strong feeling that those four can't coexist. There has to be some acquisitions going forward in the future. And I think Grubhub economically isn't performing as well in terms of like their finances. But at the moment, Uber wasn't able to do their bid. There were some other issues with the bid, in terms of their price prediction. So Uber was offering 1.9 in terms of its shares for each Grubhub share, but Grubhub wanted 2.15, and there was, all these other little isms and schisms that happen when, people are trying to, or companies are trying to buy another company. Overall, it failed. It was a big L for Uber, and that's the reason why the stock price dropped. And, one thing that's very interesting as well is that it's looking like there's a possibility that Just Eat is going to acquire Grubhub now. So it's set that Just Eat is going to acquire Grubhub at valued around 7.3 billion. Which is going to be significant, and so they're potentially going to be the next player, which is obviously going to be doubly bad news because they're quite a significant player in Europe, obviously the UK, Europe anyway, so that's going to be even bigger and stiffer competition for Uber. So it'll be interesting to see what happens, but obviously Uber wasn't able to do what they tried to do there, and so we'll have to see what happens. I can't really see them buying DoorDash. DoorDash is like Uber's main competitor from a consumer standpoint. Postmates, we shall see, probably not, to be honest. But yeah, it's going to be interesting to see what happens. But overall, 13.05% Uber dropped down. The next stock to fall is where are you? There you are, you little bastard. Lloyd's went down 13.42%, and it just goes from bad to worse with Lloyd's, really. Do you know what I mean? It really goes from. This is a stock that I've believed in for so long. We started to see a little rally this month. It getting up to the highs of 37 cents. Like, wow. And I did a post on my Insta talking about, will it ever get back to, its highs of around like 67 cents, etc. And it's about a 50-50 split. I think most people said yes, like about 55. I think about 45% of you was like, no, we'll never do that. I think eventually it could do, but, it just can't keep on being bad news after bad news anyway. The bad news for Lloyd's this week was on multiple fronts. The first thing is that Lloyd's has been fined £64 million for mishandling mortgages. I'm not going to read it all out to you. I'm going to put the link in the description. But to sum it up, effectively between 2011 and 2015, they mishandled mortgage applications for people that were in financial difficulties. It ranged from a number of things, from not escalating things to senior managers, allowing people to do things they shouldn't have been doing, having people default where they shouldn't have defaulted, etc., etc. So because of that, they were fined 64 million, and they've outlaid, I think, about 300 million in compensation to those customers and individuals. So, it's PPI, it's this, it's that, and now it's obviously mishandling mortgages. The second reason, which is actually the reason for both the second and third top faller, or first top faller rather, which I'm going to talk about together, which is Virgin Money as well. And you can see that's gone down 14.20%. So the next reason for Lloyd's is the same reason for Virgin Money as well. So I'm just going to combine it. It's the fact that the UK economy announced that in the month of April, was 20.4% down in April. So basically a fifth of the economy has shrank during the month of April alone. And there's also been some challenges with the EU departure talks as well, which is obviously naturally always going to affect the UK economy for a number of reasons. So due to mainly the economy figures, I would say that's probably the highest portion of it. That has made Virgin Money and Lloyds drop significantly this week, and why Virgin Money is the top faller at 14.2%. Again, another stock that was doing pretty decent over the last month, but is now obviously starting to go on a very significant downward trend. Me personally, I've always mentioned that I'm definitely going to be steering towards more growth stocks, but there is going to be a number of UK businesses that I still want to hold, that I still believe in, that I still can get back to numbers that are somewhat reasonable. And Virgin Money and Lloyds are definitely a part of that. So yeah, even though it's way down from some of the levels that I used to be buying it at, I'm definitely not selling Virgin Money or Lloyds. I'm definitely going to continue to hold on to both of these companies, because I know that, it doesn't take much for them to turn around and then to be profitable again in terms of a share price perspective. So I don't want to be selling hastily and missing out on future gains and having all of you lot telling me, oh, you should not have sold because look how much money I made from Virgin Money from your recommendation. So I'm just going to have to continue to hold on it, and that's basically how I'm going to move. Now, I've taken a punt. I've taken a little bit of a punt on a stock. I bought a brand new stock, and I took a little bit of a punt. It's something that I've never really done before. When I say that, I mean that every stock that I've bought here, I stood behind. Whether it was a bad investment or a good investment, I stood behind it as a stock that I've analysed to the best of my personal ability to do so, and felt that for whatever reason, it's a good investment to potentially buy. Except this stock. This stock I just bought just for the just. I bought it just for the just because, I've got people in my DMs like Mark Foskett just gassing me up about it. I've had people talk about it, over the past couple of months as well, but it weren't available on free trade. And then it landed on free trade this week, and I just thought, F it, man. I'm just going to put a little small change into it. So that stock is Nikola. I bought Nikola, which is basically the Tesla for electric trucks, and probably because I'm slightly salty for not getting into Tesla, and when Tesla did fall during the COVID situation, I'd maxed out my ISA allowance. I wasn't able to buy Tesla, so I think partly because of those reasons, I've always been a little bit salty about not getting into Tesla. So this is my B-Tech Tesla, innit? This is like this is just me getting a little bit of the Tesla shine, hopefully speaking. So I bought it yesterday. And I'm at £1.70, so I might just sell it now. No, I'm joking. But I think this goes to a broader topic for me about making punts and actually buying speculative stocks without doing research and so forth. I don't advocate it. I don't think it's a smart or sensible thing to be doing. But to put it into perspective, I put £343 into the stock, right, or £344 into the stock, right. If you look at that over the value of all of my investments that I've put in, it's basically 0.85%. So of all of my holdings, 0.85% is in Nikola. It's not going to affect me negatively in any way, even if this stock goes bankrupt for whatever reason. And if it does fall, I'll probably add more money in anyway. But it goes to a point that I wanted to talk about in terms of having a bit of just for fun money, or, a percentage of your portfolio into speculative investments where, you might just want to give it a go. And a few other, renowned investors have talked about that actually. Quite a few have spoken about that historically, about having a small part of your portfolio in just for fun, punt investments, speculative, whatever you want to call it. And I think a reasonable percentage is like 5%. If you had 5% of your portfolio in speculative, maybe higher risk stocks that you don't really know what's going to happen, but you just want to see what happens with it, then I think that's probably a reasonable figure to go towards. Any more than that, then I think you're kind of pushing it. That's my personal opinion. So, 3 to 5%, I'm sitting at 0.85%, so it's not even 1%, to be honest. So it doesn't really matter. And I'm probably going to do a few more of these just for fun, to be fair. And me personally, with my learning style and the way that I like to learn, I'm a visual learner. So what I mean by that is there's different types of learners, right? If you guys, paid attention in science, there's kinetic learners, there's auditory learners, there's visual learners. It's basically people learn in different ways. Some people are good in a classroom, some people are good just by reading something and they get it. Some people need to watch videos, some people need to actively do stuff in order to then learn it. Me personally, I like to see certain things and I like to do it. Once I do it, I learn it better by doing and by seeing it. So, if I want to learn how the stock market's working, I prefer to just invest, because I can read as much as I want to read, and I do that anyway, but I get more knowledge out of feeling it and seeing what's actually happening during the process. So, I don't mind having a few speculative investments. I would rather put some money into it that's not going to hurt me, see what happens, learn from the movements, learn from, monitoring the news on a weekly basis or on a regular basis. And then obviously based off that, hopefully I can make better and sound investment decisions in the future. So yeah, that's what I'm going to do. And so if you guys were ever doing speculative investments and so forth, then my only recommendation would be just to limit the percentage of your overall portfolio. And somewhere in the region of like 3 to 5%. I can't even get out of the screen now. 3 to 5% for me feels safe. Now, what doesn't feel safe is the UK economy. I'm going to put something on the screen. I should just put my portfolio on the screen because, this week has just been horrific. But the UK economy it just goes from bad to worse, really, to be fair. So as I mentioned earlier on, UK economy down 20.4% in April. The first, 3 months to April, February to April, 10.4% down. The Bank of England predicts that the second quarter for the UK economy will drop 25%. It dropped 2% in the first quarter, which was record numbers. If you think about, the whole 2008 crisis, it dropped 1% there. If you think about, I think 2012, it dropped like 1.5%. If you think about another time, it dropped, so I can't remember the percentage, but we're talking like small percentages of drop that caused global or UK national recessions. It dropped 2% in the first quarter. It's expected to drop 25% in the second quarter. I don't know the exact date when that will be announced, but I assume that will be around the July or August mark where that will actually get announced. And it's not pretty for the UK economy. Then you've still got the whole backdrop of Brexit. I mean, with everything else that's been going on, we've kind of forgotten about Brexit, but that still appears to be a niggling situation. So it just goes from bad to worse in terms of the UK economy. The reason why the markets overall have fallen is because the Fed basically were a bit gloomish on the US economy and said, look, it's going to be a longer, tougher return to favourable numbers and so forth. And so that's why, this week everything was kind of doing well, and then all of a sudden it just started to tank. I think, probably the best example of that would be something along the lines of, let's look at, I don't know, maybe Microsoft. But basically, in short, everything was going up and then it all kind of just dropped and tailed off. And that happened to pretty much, I would say, 90% of stocks. If you look at like the S&P 500 heat map, I think of 508 stocks, only 4% was in the green. 4 of them were in the green. I think all of them, everything else basically dropped. And so basically there's a lot of negative signs going on. And I mentioned last week that I do believe a correction is coming. This is definitely correction territory. In fact, it's probably greater than correction territory. But I think even broader than this, I think we are looking at a potential time where the markets are going to tank quite significantly. And so, I would say, and this is just a theory, right? I'm not saying I can't predict the future, and a lot of my predictions are usually wrong, but I was right last week, so maybe I'll be right again, who knows? But what I mean by this is that I would suspect that a lot of these stocks over the next few months would drop significantly. And so, you've got to make a decision on your portfolio, whether you're willing to sell now, keep the money in cash, just leave it there, waiting for, prices to be a bit more favourable and buy back in, whether you're just going to hold it, keep the shares there and then buy more when the opportunity comes to do so, and, take the 40-50% L's when they come, or whether you're just going to ignore all of that and just be bullish and just keep buying or dollar cost averaging or, whatever it is you guys do. So, I think there's a lot of thinking that's going to happen, because I do think the next the next couple of weeks, the next couple of months is definitely going to be very, very interesting in seeing what's going to happen in the market. I think the overall, by the end of the year, if I want to be a bit more positive and end on a positive note, I think by the end of the year, I think markets around the world will start to recover and will be in good shape, to be honest. But I definitely think, during this summer, it's going to be a hot summer, man. It's going to be a hot stock summer, and we'll see what's happening around that. But yeah, hopefully you found this useful. If you did, like, comment, subscribe, and I will catch you next time with another investment video. Take care. Peace.